What's up there, investors? Welcome to my channel. This is the Frugal Investor. On this channel, we talk about financial independence, M1 finance portfolio, and the stock market every week. If you like this type of content, please click subscribe and press the bell icon so that you get notified every time we post a video. Also, don't forget to click like, smash the like button for this video for the YouTube algorithm. In this video, I am going to give you guys the top 3 dividend stocks that you can hold in your portfolio during the times of recession. With that said, let's get right into it. The first stock on this list is Canadian Pacific. Canadian Pacific is a railway company that is the reason why Canada exists today. It is a 150 years old company that connects the East Canadian part to the western part. They also do business in the United States. They are mainly they supply grain and transport grain from east to west and to United States. This is one of the most essential businesses for the survival of this Canada and for survival of some United States parts. During rough times like recession, this stock will do well because this is essential for the survival of these two countries. If we look at the growth during the past year, the stock is up by 38% just in the past year. In the past 5 years, the stock is up by 153%. That is a huge amount of growth. They also have been constantly able to increase their top line. Now some years it did go down a little bit, but most of the time their top line has been constantly increasing. If we look at their bottom line has also been constantly increasing. In fact, it has almost quadrupled from the past 6 years. That is a huge amount of growth in the bottom line as well. The company is very profitable. It's a very well managed business, as we can see. If we look at their dividends, the dividend yield is 0.85% and the annual payout is 0.62 cents. The payout ratio is 19%, so there is a huge room for growth, and the 5-year growth rate is 20%. That is a huge amount of growth for the dividend income. The dividend safety score for Canadian Pacific Railway is 76, so it's a very safe dividend paying company, and the beta for them is 0.74, so it's not that volatile. Beta of 1 is S&P 500, below 1 is less volatile, above 1 is more volatile than S&P 500. 0.74 beta is not that volatile. They have such a safe dividend paying model. They have such a safe business model that will do better. It is essential for survival of the two countries, and the dividend has seen a huge amount of growth, and it will continue to see a huge amount of growth in the upcoming years. The second business on this list is Duke Energy Corporation. Duke Energy is an energy company which has been in business since 2005. Now the interesting thing about energy companies is they are government regulated. They have no competition, and the business model is in a way where the dividend income is stable. It does not go anywhere because they're regulated by the government. So there is almost no way these businesses can go out of business. It is one of the most stable dividend payer in my portfolio, and I have it in my portfolio only for the reason because this pays a constant stable growing dividend income. If we look at the growth in the stock, the past 1 year the stock is up by almost 25%, and in the past 5 years the stock is up by almost 21%. So the growth is not a huge number. Their top line has been growing at a steady pace. Their bottom line, it fluctuates, it goes down, it goes back up because of hurricanes. They have to do asset recovery, and they have to open new plants and stuff like that, but they are a profitable business. If we look at their dividend income, now the dividend yield is 3.79%. That is a huge amount of dividend yield. They pay out a dividend of $3.94 every year, and the payout ratio is 76%. The growth rate is 3.18% over the past 5 years. The dividend safety score for Duke Energy is 80. So it is a very safe dividend paying company, recession or no recession. But during the recession, this is very safe to hold in your portfolio. If you look at the beta, which is a volatility, it's 0.37, so it's very less volatile. It stays at a stable price and just keeps pushing out the sweet stable dividend income. The third business on this list is the most interesting one and is one of my most favorite. That is Equinix. Equinix is a REIT, but it is not like a regular REIT, like a triple net REIT, like Realty Income Corp and stuff like that. It's not like that. It's a different REIT. It's a data center REIT. Data centers are growing in the future. We are becoming a data hungry species. People need more and more data, more and more technology. So there is a lot of room for this company to grow. And this is also one of the biggest players in the data center industry all across the world. All across the world, this is one of the biggest players. So this is very well positioned. If the needs for data are increasing in developing countries, this company is very well positioned, very well diversified across different continents to use that, to harness that increasing growth and use it for its own benefit. So there is a lot of room for this company to grow. Top line has constantly been growing. There has been a stable increase in their top line year over year over the past 10 years. If we look at their bottom line has also been growing. It has been fluctuating, going up and down a little bit, but the company is profitable and most of the bottom line has been growing over the past 10 years. That is a really great sign that the company is doing good. Their dividend yield is 1.38% and the annual payout is $11.48 per stock. So that is a huge amount of dividend that they pay out. That is also because the stock price is almost $800. So that $11.48 is a good amount of annual payout, and the payout ratio is 57%, and the 5-year growth rate is almost 10%. If we look at the dividend safety score, the dividend safety score is 86, so it is a very safe dividend paying company, and the beta is 0.66, so it's not very volatile. So this is one of the best companies to hold in terms of recession, because this company will always be in business. We will always need data and technology and phones. We are so much data dependent now, we cannot survive without it. So this company is a very essential business, along with Canadian Pacific and along with Duke Energy Company. The price of the stock is $834. So if you think that that price is too high and you want to buy something cheaper, Digital Realty Trust, DLR, is also a very good company that you can add to your portfolio. And the dividend safety score for Digital Realty is 94, so it's even more than Equinix, and the price is $157 for the stock, and the dividend yield is 2.95%. If you think that Equinix is too overpriced, the stock price is almost close to $900, so if you think it is too overpriced, you can add Digital Realty Trust. The annual payout for Digital Realty Trust is $4.64, and the dividend yield is 2.95%. So it also pays out a great number of dividend. As compared to Equinix, it pays more dividend. It has a better safety score. That is also one another business that you can add if you don't like Equinix. So those were my 3 recession-proof stocks that you can add to your portfolio. And in my humble opinion, recession or no recession, you should own these stocks in your dividend portfolio because of the type of business that they are in. Moving on to my portfolio. To give you guys a quick update on my portfolio, the current value is $167,728. The portfolio is up by almost 20% over the past 6 months, and the gain is almost $23,667, out of which dividend is $1,530 is dividend. So that is the current state of my portfolio, the amount of growth, and currently the biggest gainers is the tech sector. The tech sector has produced the biggest gains for me so far. Just in Apple, I'm up by almost $2,600, and Google $2,900, Facebook $2,200. So these companies are doing really well. Etsy is down right now. Etsy is currently selling for $182, so I'm thinking about buying more Etsy. I'm waiting for it to go below 180. So Etsy is the only stock in the market right now that I am looking to buy, because it's a little bit cheaper. It's a little bit in the red from the past couple of months. So Etsy is what I'm looking to buy this coming month to my portfolio, because everything else looks so overpriced right now. So I'm not really thinking about adding any other businesses other than Etsy. Also, financials are doing really well as well. JP Morgan and Chase and Capital One Financial, they have been doing really well for my portfolio. Capital One is almost up by 84% just in the past 4 months, and JP Morgan is up by 23% in the past 4 months. So I entered into most of these companies when everybody was scared in the time of September, November. There was still fear in the market. That the market is going to crash, or we are not done yet, we're not recovered yet, and that was the time when I bought into it. I didn't buy it during complete low during the month of March and April, because I thought it would go down more, and I was waiting for it to hit bottom. But during the month of September, November, I felt like this was a safe and opportune time to get into the market, and that's why I got in. And I bought most of these companies, and so far they have been doing really well for me. And if you want to check out this portfolio, I will leave a link in the description down below, and you can check out what companies I hold, and what is my dividend yield, and so forth. And you see, and let me know how you like these companies. Which companies do you hold? Which companies do you think is a great add for your portfolio? So that is my portfolio so far, and those are the best three dividend companies. If I show you, I personally hold all those three companies. Canadian Pacific, I hold almost here. Canadian Pacific, I hold about 72 stocks of Canadian Pacific, and it has done really well for me. So far, I am up by almost 2%, and the dividend is $11. So it's good for me. It's a stable dividend paying company, and I'm happy with this company. The other one is Equinix. So Equinix is in real estate. It's a REIT. I also hold Equinix, and Equinix I hold about 7 stocks, and so far it's up by almost 23%, $1,100 in gains and $20 in dividend from Equinix. So this has also been doing really well for me, Equinix. And the third company is Duke Energy Corporation. So Duke Energy Corporation, I hold about 43 stocks, and so far it's up by almost 16%, and it has given me a dividend of $40 so far in the past 6 months. So these are the three companies that we talked about. We also went over my portfolio, what I'm looking to buy. I'm looking to buy more Etsy because the stock is down. If it goes below 180, I'm gonna buy more. So that was a quick update on my portfolio as well. If you like this type of content, leave me a like. Comment down below what you guys like and what you guys don't. Subscribe to the channel. And yeah, that's it.